So learning objective 2 introduces you to ratios, okay? Because ratios are important in that we help to evaluate the company's financial health when we use ratios. I'd like you to think how important ratios are even in your own health. When you went to see a doctor, right, for a checkup, they're often using ratios to evaluate your health. They're looking at your blood pressure, your body mass index. They're looking at if you have blood work, cholesterol, or other types of ratios. They want to make sure they're using these ratios to evaluate your general health. And if some ratios are off, or not within a decent range, they'll explore it further. Well, that's what accountants, financial analysts, and managers do with the numbers that are provided for the company. They use a ratio, something called ratio analysis, to evaluate the company's financial health. So you're going to be looking at this today in three particular areas: the profitability of the company, the liquidity of the company, and the solvency of the company. So we're going to look at those here in this part of the chapter here. So the first ones are profitability ratios. And again, they, just like the term is in their profitably, how to look at the profit from the perspective of a stockholder. Remember, corporations are broken into many different shares of ownership. What if you only have one share of ownership, right? Well, what's my share of the profit is really what profitability ratios are really about. And so remember, you have revenues, you subtract expenses, you got those profits, we call net earnings. Profitability ratio will tell you what's your share of that. Then we're going to look at liquidity ratios. The term liquidity here again, being able to get a hold of cash quickly or turn things into cash quickly. Why would you need cash? Well, you need to pay your bills. All bills are paid in cash. You pay your rent in cash, you pay your employees in cash, everything you're paying is in cash. So you need access to cash. So liquidity ratios tell us how quickly we can get access to the cash and in order to pay current bills. Solvency ratios look the other way. They look at the long-term debt. Every company has debts, and that's not necessarily a bad thing. But can they manage them over the long term? And so we look at a solvency ratio to tell us how the company is able to manage that. So for all ratios, we need to use the financial statements. So let's take a look first at our beautiful income statement here, right? So this is one for Best Buy for two accounting years. 2013 is listed all the way to the right, 2014 in the middle here. And it tells us what the revenues are for each of those years, what the expenses are for each of those years, and whether the company had a net profit or a loss. And so as you see in 2014, the company had a profit of $532,000. Unfortunately, that did not happen in the previous year. In the previous year, they actually lost 441 million. Now, all of these amounts, by the way, are in millions. So you got to add 6 zeros to sort of understand where I'm getting these numbers from. Okay, so so basically speaking, if you were a shareholder in Best Buy in 2014 and they had a $532 million profit, it's reasonable to ask, well, what's my share of the profit? I'm an owner. What's my share of that? And that's really what the earnings per share ratio tells us, is if we were to take all of the profits, remember the word earnings, profit, net income all mean the same thing. They're all interchangeable. If we were to look at the profits on a per share basis, because that's how corporations are split up, ownership is split per share, how much would my profit be per share? Right. So that's basically what earnings per share tells us. And this, again, tells us basically how to do it. We're going to focus on their profitable year, 2014. They had a $532 million profit. Again, everything is in millions. And they would need to divide that, in essence, by all of their stockholders. So basically speaking, you need to understand that over the course of a given year, companies typically either sell more shares of stock to raise money on the market. And so they'll have more shares, like what happened here. At the beginning of the year, they had 338 million shares. By the end of this year, 2014, they had 347 million. Or in some cases, companies will buy back their shares. So they'll go and actually buy shares off the market. And so that would mean a reduction in total shares over the course of the year. And that's what happened the previous year. So we take the total amount of the profit and we simply divide it by the average shares for that particular year. So this is what the formula will say: the net income of the company minus what they call preferred dividends. Now, preferred dividends, 94% of the time is going to be zero, because most corporations do not have preferred stock. And preferred stock get what they call preferred dividends. And since most corporations don't have preferred stock, they don't pay preferred dividends. So like I said, most of the time, this is going to be zero. So it's going to be the net profit of the company divided by the average common shares, which are these two numbers added together and divided by 2. So for 2014, when you take a $532 million profit and divide it by, say, about 342 million shares, roughly, you're going to get basically $1.55 of the earnings per share. So literally, if they broke up the $532 million into every single share, that's what it would be, $1.55 each. In the previous year here, sadly, they had a loss. So again, when a company is profitable, the owners keep the profit, or the owners can retain the profit, right, of the company. And they get the benefit of that. But when a corporation or any company takes a loss, it's the owner's job to cover the loss. Okay. So this net income is added to retained earnings. When a company has a loss, it's subtracted from retained earnings. Okay. And this again, it's based on whether the owners want to continue. It's their profit. It's also their loss. And this is what's happened, you see, in the past year with a lot of restaurants and other businesses with COVID. They've had losses. Their revenue has gone way down. Their expenses have not. And so they're taking loss after loss after loss. And it's really up to the owner to say, I'm going to cover the loss so I can continue in business. Or they'll just say, look, I'm not going to cover, I'm done. I can barely cover this loss. I can't continue. And boom, the business closes. But that's basically the determining factor. Okay. So they give you a little bit of a review question about this company, Stoneland. They had a profit of 26,000. That's really, really wonderful. They had net sales of 400,000. Again, like in many accounting things, they're going to give you lots of numbers. We don't really care about what the sales are in this, because we're looking at earnings per share. This is an earnings per share question. They have average shares of 6,000, and of course it's a textbook, so they paid preferred dividends. Okay, so you start with the profit that they made, 26,000. You take away the 2,000 in preferred dividends, that leaves you 24,000. And that 24,000 is divided by 6,000 shareholders. And so each shareholder would get $4 in earnings per share. And that's how you would do it. The next two ratios, types of ratios rather, the liquidity ratios and the solvency ratios, really are going to be, the numbers we need are going to come right from the classified balance sheet. Okay. And here is the classified balance sheet for Best Buy. Again, this is also in millions. And so you have to add 6 zeros to all these numbers to get the right one. So what type of information do we need? Well, for the most part, for liquidity, we're really kind of talking about current assets. Okay. And we use our current assets to cover all of our current debt. Current debt we call current liabilities. So we are going to need to know, in essence, the ratio, the relationship between these numbers for liquidity ratios. For solvency ratios, we're looking at total debt compared to the company's total asset base. how much debt did they had to borrow to buy all these assets? And that's basically what solvency looks at. Okay, so one at a time. Liquidity ratios, there are two of them that your book introduces you to. The first is something called working capital, which is simply the difference between your total current assets and your total current liabilities. It's simply subtracting them. So Best Buy, if you look back here, again, their total current assets were 10,485,000,000. Their current liabilities totaled 7,436,000,000. So when you subtract that out, you'll see they had working capital of just over 3 billion, which again is the total current asset number minus the total current liability number. And probably a very popular financial ratio for liquidity is something called a current ratio, which simply looks at the relationship between current assets and current liabilities. Okay, so the total current assets are compared to total current liabilities. So let's take a look at Best Buy's numbers 2014. It's the same two numbers. But on the top, we have 10,000, the current assets, 10,485,000,000, divided by the current liability, 7,436,000,000. That gives us a current ratio 1.41 to 1. Now, what does this mean? Well, that first number represents the amount of current assets for every dollar of current liabilities. So we would read this, that Best Buy had a current ratio in 2014 of $1.41 of current assets for every dollar in current liabilities. Okay, so again, first number, current assets, second number, current liabilities. That's better than their 2013 number. Here is 1.11 to 1. That means they had that first number, again, current assets to current liabilities. So $1.11 of current assets to cover every dollar in current liabilities. Clearly, they've improved because you want a lot more current assets than current liabilities. Again, if you're looking at liquidity, you want to make sure you have plenty of current assets to pay your current bills. Boom. They give you they introduce you to another retailer. This retailer is called H.H. Gregg. H.H. Gregg is simply a Best Buy, but it looks the same if you walk in. I've been in one. They're in Maryland, Virginia, and points south of there. And as you see, their current ratio is listed at 1.68 to 1, which means basically they have $1.68 of current assets to cover every dollar in current liabilities. Okay. Now, because that's a much higher ratio, they're better off, they're in a better off position than Best Buy is, because their current ratio is much higher. So they're not going to be under any stress grabbing cash to pay their bills. Okay. The industry means all the businesses that do the same type of thing is an industry. So this particular industry is the electronics retail industry, which is basically, it's very competitive and it's very difficult to survive. You might, in your lifetime, you have already seen some casualties. When you were much younger, you might have heard of a company called Circuit City. Circuit City went out of business. They were a big rival to Best Buy. And most recently, in the last couple of years, that might hit home with your memory a little better, was Radio Shack. Radio Shack also was in the same industry, electronics type of industry. So this is a terrible industry. It's very, very competitive. And as you see, the industry itself is suffering with its liquidity. It has 88 cents of current assets to cover every dollar in current liabilities. So they clearly have a liquidity ratio issue here. Okay, they don't have enough current assets to cover their current debt. So how are they going to pay that current debt when the time comes? They might need to borrow more money, which doesn't help. Right. So that's how this particular ratio works. Solvency ratio, basically two things. It's about long-term debt, and two things come with long-term debt. You're going to pay interest on that debt. Doesn't matter how much debt you have, you're always going to be paying interest. That interest is always current. And then, of course, you have to pay the debt back eventually. Unless you're, unless you're the United States of America, you just keep refinancing trillions of dollars. But most companies have to eventually pay their debt. So, solvency ratio basically will tell us that relationship. So let's take a look at it. The debt to asset ratio is the most popular one and the one they introduce you to. And it's basically that, just the total debt of the company compared to the total assets of the company. That's it. That's all this ratio tells us about. So this is what the ratio looks like in a formula, right? Total liabilities on top, total assets on the bottom. And here for Best Buy in 2014, what you've got here is the total liabilities of the company at over 10 billion, total assets of the company of over 14 billion. So their debt to asset ratio is 72%. Now, a way to think about this is for every dollar of assets they had to finance it with 72% debt. Okay. So that's basically how you would look at the debt to assets. 72 cents of debt for every dollar of asset would be what Best Buy had in 2014. In 2013, it was 78 cents on every dollar. So they've actually gotten better because they've lowered their dependence on debt to finance their assets. H.H. Gregg clearly in a much better position. They are not very heavily, they don't rely very heavily on debt. It's only a 51% debt to asset ratio, which means for every dollar of assets, they only have to borrow 51 cents to buy them, which means it's just not relying on debt. It's probably going to be quite well. The industry is under incredible stress. Okay, the industry is under incredible stress. In 2014, the industry had a debt to asset ratio of 88%, which means that 88% of its assets were financed with debt, right? For every dollar of asset they had to borrow 88 cents to get it. So that's crazy because this is a retail store. This is a retail store. They don't make anything; they just sell stuff. So it's crazy that this particular industry has such high reliance on debt. And you see that in a lot of other stores that have closed over the years. Toys R Us had way too much debt. They couldn't finance it. They went out of business. You're seeing that going on with JCPenney, a little bit less with Macy's because they're restructuring. Sears, Kmart, probably would be dead soon. I mean, they're all just overly indebted and relying on debt, and they don't make anything. Where this wouldn't bother me so much if I saw Tesla had an 88% debt to asset ratio, it wouldn't bother me so much. If I saw that an airline had an 88% debt to asset ratio, probably wouldn't bother me so much. Why? Well, because to run an airline, you need airplanes. And airplanes cost a lot of money, and chances are you're going to borrow money to buy them. But it's those airplanes that are making you money. Right? So it doesn't bother me. You have ways of paying that back. For Tesla or other automakers, they need factories, they need robotics and other type of specialized equipment. All that costs a lot of money. Those assets cost a lot of money. They're going to be borrowing money to buy most of it. So, and then of course they make the cars and other stuff that they need to pay it back. So it doesn't bother me so much when those types of companies have high debt ratios. But this is a retailer. They don't make nothing. All they do is sell stuff. That's it. So this is really problematic for the industry. Okay. And again, some debt is okay depending on the industry. And so here again, General Motors, I don't know what year this was taken from, has a much higher debt to equity ratio than Google. Does it bother me? No, because General Motors needs factories, they need equipment, they need things that lots of property, plant, equipment that cost a ton of money, and borrowing money to buy it is normal for that. This is a real estate firm, same thing. I mean, the reason that they have they buy, they build malls or they build apartments. Is they borrowing money to do that? So would it bother me so much? No. It depends on the industry, right? So different industries, different companies, you're going to have various uses for debt. Some of it makes sense, some of it doesn't make sense. We are not going to be doing the cash flow statement, so you don't have to worry about that. The do it exercise too is just simply practicing the financial ratios that you learned here. So earnings per share is, and there's two years of information for this company, Ozone. So again, earnings per share, net income minus preferred dividends divided by average shares gives you the earnings or profit. Remember, earnings is the same as profit or net income per share. That was higher than it was in the previous year. So clearly that's a good thing. Matter of fact, that's what really for years and years Wall Street has been based on. Companies have high stock prices because their shares of ownership are earning more of the profit. Thus, they're becoming more valuable. When these other things happen, like with GameStop, et cetera, the company is going bankrupt fast. So the fact that it had at one point a $300 or $400 stock doesn't make any sense. That's pure speculation. It's not based on any earnings as to why the company shares are worth that much or valuable. Current ratio, again, current assets to current liabilities, current assets to current liabilities. If you know the year you're talking about, you know where to get current assets and current liabilities from the classified balance sheet. Here they went from a current ratio of 1.6 to 1 to 2.2 to 1. So clearly they are in a very strong position. Debt to asset ratio looks at total debt, total liabilities over total assets for each year. As you see, they had a higher, even though 44% is not bad. In 2017, it went down to 30%. So clearly they're doing quite well here as well. So that's a look at learning objective 2. We're going to take a quick break for questions.